All right. So, welcome to lesson three, credit cards and loans. This is assuming that you have watched the videos for lesson one and lesson two, especially on credit cards and on credit scores. Okay. So, we're going to be talking about credit cards and loans today. Okay. Just a little disclaimer. This is not all the information you need. This is a great piece of information for young people to get information about these two things. Okay. So, what is a credit card? Well, credit cards are exactly the same as like a debit card in functionality. You can buy things in person or online, just like a debit card. But the main difference is that you're not using cash, you're paying with credit. So, you're not actually using any of your own money. The way it actually works is that you are paying with money, but by using the credit card, you're having the bank pay, whatever the bank is. You can see here that we've got two banks here, Mission Lane and Capital One. These are the banks that are the reason you have a name on your card is that is the name of the bank that's actually promising to that's paying the money for you, and you're promising to pay them back. Okay. Credit cards are the best way to build your credit score as a young person. There's no other way that's as good as this for you guys. But unfortunately, it's also the easiest way to destroy your credit. If you mess around with credit cards and don't use them properly, they can ruin your credit and cost you a lot of money. Okay, so it's really important that you pay attention and learn how to use them here so we can use them to our benefit. Okay, so first off, why do credit cards exist? Um, for banks to make money. There's no real reason why credit card should exist other than that. I mean, there are benefits. Well, of course, being able to buy things you don't have money for is actually really useful in a lot of situations. I use it for things around the house, or let's say I need to pay off a big bill, like my electricity broke and I had to pay an electrician, and I used a credit card for that, and that was really useful. But in general, it's credit cards are there to make money, okay, for banks. Okay, but it's possible to have multiple credit cards and never pay a bank a cent, okay, all the while increasing your credit score. Okay, so keep in mind the rules about credit from before, and I'm also not going to reference them as much, but to also think back about how to use a credit card. I'm going to talk to you guys about the main thing you want to do, which is to pay off your balance every month. If you don't pay off your balance, you have to pay interest, and for credit cards, this adds up really quickly. Okay, let's talk about this. So the main rule for a credit card is you have to pay off your entire balance every month. This is the pretty much the golden rule, and this makes it so that you don't pay any interest. Okay, so you basically don't pay any extra money. You're just paying the money that you owe them, and there's no extra money, which is great. Okay, and so at the same time, if you're paying off your balance every month, it's going to increase your credit. Because remember, we want a low balance for our credit score, right? We have low balances. Banks are betting that you won't. Okay, so if they're betting on the fact that you're not going to, because if you don't pay your balance off every month, you pay tons of money for it. And the main problem people get into is they think, okay, well, I'll just pay the minimum payment. If I pay the minimum payment, I'll be fine. Never do this. Always pay off your entire balance if you're able to. Pay as much of it as possible. In this situation here on our screen here, if you can only pay $1,000 of your credit card bill, pay the whole $1,000. Don't pay just the $45 minimum payment. Okay, you must pay as much as you possibly can. Okay, remember, on-time payments are the most important thing for credit scores, but having a low balance is really important. So having your balance as low as possible is most important. But if you want to avoid paying interest, you want to pay it all off. Let me explain why that is. Okay, if you leave a balance on a credit card, it's not going to help your credit. It's actually going to cost you money. Okay, if you don't pay the entire balance each month, the bank's going to calculate how much money is left and make you pay interest. And this is called APR. Okay, and this isn't a small amount. It's like the 16 to 32%, which is huge. Okay, so for example, if you have $1,000 balance at the end of the month and your APR is 32%, very common for people who have low credit or your first time credit card, they're going to charge you $320. Okay, and then it goes onto your statement and you owe $320, $1,320. Okay, if you pay like the minimum payment on a $1,300 like credit card payment can be as low as like $80. So if you only pay $80, then they're going to charge you another like $400 in interest. So your credit card bill gets bigger and bigger and bigger if you only pay the minimum payments. Never pay the minimum payments. They are a scam. They're trying to get you to pay low amounts so they can charge you more in interest. So never pay the minimum payments. This is how banks make money. They're literally trying to trick you into paying more interest. So don't do it. Always pay the maximum amount you can in your balance. And if you can, pay off your balance every month. You should never be putting more money on a credit card than you already own. Okay. Get a credit card as soon as you can to help build your credit. Okay. But here's the key: make small purchases that you can pay off each month. Use it to buy some food at McDonald's, and that's it. Use it to buy like a pack of Magic cards. Use it to buy a couple of shirts at the mall. Don't spend a lot of money. Spend maybe $100 maximum, and then you can pay it off easily each month, and that's going to build your credit because it's going to keep your balance low. The lower the balance you have, the more on-time payments you have, the better your credit can be. Don't only spend money you already have. Never spend money you don't have unless, okay, you are very experienced. I would say, well, don't do that for the first couple of years. Don't spend money that you don't have. Okay. Now, you're thinking to yourself, okay, I want to buy something really expensive, like a car and a house, but I don't have cash. What should I do? Striking our heads. This is what a loan is. Okay. A loan is when you want to buy something really expensive, but you don't have cash. What should you do? Well, getting a loan is your options here. Okay. What is a loan? Well, it's just like it sounds. They're going to loan you a large amount of money and you have to pay it back in installments. But the big key is that plus interest. They're never going to give you a loan for free. Okay. Before normal banks got all crazy on the stock market, see the 2008 financial crisis for when the banks went crazy, the major way for banks to make money was loaning it out to people and who would pay interest on those loans every month. So they calculated every month. Okay. The more money that they had, the more they could loan. And that's why they offered savings accounts. See back to our first lesson talking about savings accounts and how they actually pay you for it. As you'll see, though, they make a lot more money on loans than they give away at savings accounts. So it's to their interest to give out as much loans as possible. Now, unlike credit cards, interest payments on loans are unavoidable, and you have to pay them as part of the loan process. The better or worse your credit score, the better or worse your interest rate. So if you have a really good credit score, your interest rate is going to be low. But if you have a really bad credit score, your interest rate is going to be high, or you're going to be denied a loan. Okay, this is why you want to still start building your credit now, because if you build your credit now, then you can have a good credit score before you need to buy a loan, and you can pay thousands and thousands of dollars less in interest. Okay, so think more about back to our credit score lesson last time to think about how to build your credit before you get a loan. So build your credit with a credit card so you can get a really good loan to buy a house or a car. Okay, these are good investments. Okay, when you have a loan, it's actually very good. Remember, you want to have a mix of credit to actually have a good credit score. But buying a house in particular can be a really good investment. You'll need to buy a car sometime in your life. Be ready for when you need to by having a good credit score. Okay. Now, you can get a loan without good credit. So you can get a loan that's, if you don't have any credit or you have bad credit, you can get a loan. You hear it on the radio. They go, good credit, bad credit, no credit. We can give you a loan. And that's fine. I mean, you can get a loan nowadays from sketchy car dealers and unscrupulous banks. But they will charge you a lot of money interests. We're talking like really higher interest rates, talking like 10% interest rates, which are insane on a loan. Okay. Sometimes people end up paying more in interest than the actual value of the loan. For example, you might get a $10,000 loan for a car, which is pretty normal for like a good used car. But if you have a high interest rate, you might end up paying over $20,000 or more over the course of the 5 or 10 year period of the loan. So in general, you're going to pay more for actually ordering the money than you would normally. So you really want a low payment, and don't be fooled by this no payments for 12 months. Today I saw this one for 0% APR. Don't fall for those things, especially if you're not really experienced with loans. If you have a low credit score, that stuff is a sham. Okay, no matter what, you're going to be paying interest in one way or another. They wouldn't be giving you this loan if they weren't making money off you. So especially if you're not experienced with money, banks will try to fool you into thinking you're getting a loan for free or almost free. These situations are almost always too good to be true. Okay, the only people who get almost free loans are those who have perfect 850 credit scores, and even they don't get that. Don't be a sucker. Okay, always read the fine print and learn exactly how much you're going to be paying per month, and is that going to change? Okay, and we'll talk about that in a little bit here. But sometimes loan payments change over time, and so you have to be really careful. Okay, what are you signing? Okay. Okay, I know this will cost money, but how do I get the best deal on my loan? Okay. You're thinking to yourself, okay, well, okay, there's a lot of stuff here. How am I going to do this? I want to get a good deal, right? How do I get the best deal? Well, let's break it down into some steps, okay, so that you guys can kind of easily check it off in your head about how to get your best deal on loan, okay? So first things first, good credit score. Having a good credit score is really important for a good loan. It just kind of sets you up. They're going to be able to apply for more money. So you're going to be able to get more money with a good credit score, or you're going to be able to get a lower interest rate, which is really important. So that's really important things. See lesson 2. Number 2 is the down payment. Now, usually almost every time you get a loan, you have to pay a certain amount of it first, a certain percentage of it. So if you have a $1,000 loan, okay, which is a pretty small loan, you want to pay a certain percentage of it, okay? So it's kind of like almost like a little promise. Like, I'm going to pay my loan. Here's some ahead of time to pay for it, okay? Okay. A lot of people hear a down payment on a house, but you also want to have a down payment on a car loan. And sometimes they'll say like, no down payment necessary, which you're going to want to put something down. Okay. If you put below 10% of your loan down as a down payment, you're going to pay more for your loan because there's other reasons why. There's a lot of reasons, but just trust me, if you pay less than 10%, you're going to pay a lot. Between 10 and 25% is a good down payment. You want to pay like between 10 and 10%, like 1/10 or 1/4 of the amount of the loan, and you're going to get a good return on that. Your interest rate will probably go down too. Same with if you want to do more than 25%, really good idea. If you can put down a lot of money, you can save money. Or if you actually in the position to spend more than 25% on a loan, you can actually get more money. Okay. Make sure you have a regular income and you can pay your bill. That's really important. Okay. Banks will want proof for employment. So having a job is really important before you get a loan. And your payment should not be more than 50% of your income. Okay. So you should never be paying more than 50%. That's going to put you out too much. You don't want to do that. Now, last 2 are much more situational. Understand the risk of your purchase. Don't buy something crappy with a loan. If you see a car think of it like this. You're going to have to pay off this loan for 5, 10, or 30 years. You want something that's going to last you that long, right? Don't buy something crappy that's only going to last 2 years, because then you're still going to have to pay when it's gone. You're still going to have to pay that loan over the last 3 years. Okay. Don't buy a crappy house with a loan. Okay. You're going to have to, if you have a crappy house and it goes down in value, you're going to have to pay that loan no matter what. That's called going underwater on a mortgage. And you don't want to do that. Okay. And here's the last one. Know exactly how much money your payment will be each month. And if you got a fixed or variable interest rate. So I'm not going to go into those different types, but what happens is a fixed interest rate stays the same. A variable interest rate changes. So you need to know how much your money is going to be, how much your payments are going to be each month for the entire time of the loan. You need to know exactly how much money you're paying. And if you don't know, you need to ask somebody. You can ask me, okay? I'll help you out. So right here, I'm going to put this in the Google Classroom, okay? But you can actually calculate a payment schedule for a mortgage, okay? We're kind of running out of time here, so I'm going to keep moving on. But here you can actually, in the slideshow, you can actually use the website to figure out how much a mortgage costs over the course of 30 years. You'll be surprised by how much interest you pay. It's actually insane, okay? Last but not least, I know this is on your mind, is student loans, okay? Student loans are exciting because we get to go to college. They're also very some people are very scared of them, but in general, it's allow you to go to college, right? So this is something that's kind of a big deal. And I don't have a lot to say about this because it's very complicated, but it's a big deal to make a student loan. It's probably the first loan you might make a decision on. And let me tell you a little bit, some information about it, okay? So should you take out a student loan for college? Well, this is a personal question. You're gonna have to decide for yourself. What's nice about student loans is that you don't have to pay them while you're at school usually, but once you finish school, they can be really expensive depending on how much money you actually took out. They can be similar to mortgages, and there's a lot of interest that you have to pay, and you can pay a lot of extra money in that interest. Now, college is invaluable in society today and can be really worth it. And this may be controversial, especially as a teacher myself who went to college. I've been to college, and I think college is worth it for me. But sometimes for some people, it's not worth it to go into debt for college. So you have to be thinking about this. You need to go back to Rule 4. Okay, what is Rule 4? Understands the risk of your purchases. Don't buy something crappy with a loan. So make sure your education is worth it to you. make sure that this is something that's valuable to you that you're going to need, okay? Because it's still going to be an investment you've got to pay for. Remember, you're buying a loan, you're going to have to pay it back. It's going to cost extra money, and that's why the banks are willing to give you money for college. Make sure you're really ready to pay up. The truth is, many people have trouble paying off student loans. So please understand that before you take them out for college, you've really got to think about the costs and risks, okay? So many of the rules, if not all, apply to student loans that apply to loans as well. Okay, please read all the fine print and ask around if you have questions. Ask somebody who has paid a loan before. Okay, if you know, ask a teacher. Okay, there's a lot of teachers who have loans or have had loans, still have them. You need to ask around and figure out information. I can always help you too. Ask an adult you trust who's been to college, who's taken out a loan, get some advice. You're not on your own. Try to get some help. Okay, and there you go. Hopefully that helped out. Please let me know if you have any questions, or let your instructor know if you have any questions. There you go.